Welcome back, dear students and scholars. We have reached the final review video for ASC 330 inventory. Across this series, we have moved from inventory identity and cutoff to cost capitalization, cost flow methods, last in, first out, valuation, and practice cases. Today, we bring everything together into one clear map. We will revise the full topic, review close process controls, identify common mistakes, compare US GAAP with IFRS, and keep the SAP discussion intentionally limited. Inventory is a current asset, but the decisions behind it are not small at all. Think of ASC 330 as a sequence. First, identify whether the item is inventory. Second, confirm control and cutoff because you should not build cost on goods the entity does not control. Third, build inventory cost using the condition and location principle. Fourth, assign the cost flow using the appropriate method. If you skip the order, errors start multiplying. Testing valuation before cutoff is like checking the price tag on goods you may not even own. It may feel efficient, but it is not accounting discipline. Start with control. Inventory is not decided by physical location alone. Include goods held for sale, goods in production, and goods used in production when the entity controls them. Under FOB shipping point, the buyer generally records goods in transit once title passes at origin. Under consignment, the consigner keeps the inventory until the consignee sells to the end customer. At the same time, be careful with FOB destination, buybacks, high return arrangements, and any situation where possession and ownership are not aligned. The first question is always who controls the goods before we ask what they cost. Once control is clear, cost follows condition and location. Capitalize normal costs that bring inventory to its present condition and location, such as purchase price net of trade discounts and rebates, freight in, transit insurance, import duties, handling charges, direct materials, direct labor, and normal production overhead. Expense selling, marketing, distribution, abnormal spoilage, avoidable rework, idle facility costs, most general administrative overhead, and interest costs except for qualifying assets under ASC 835. Inventory carries the normal cost of getting goods ready for sale, not the cost of selling them or fixing avoidable mistakes. Cost flow assigns timing. Specific identification traces the actual cost of a specific item sold and works best for unique or high value goods. Standard cost uses a predetermined normal cost per unit, but variances must be reviewed so the result approximates actual cost. Average cost smooths old and new costs, with weighted average used periodically and moving average updated in perpetual systems. First in, first out sends the oldest cost to cost of goods sold first and leaves recent cost in ending inventory. Last in, first out sends the newest cost to cost of goods sold first, is permitted under US GAAP, creates reserve issues in rising price environments, and is prohibited under IFRS. The method changes timing, not total lifetime cost. Last in, first out needs layer discipline. The base layer is the original quantity at the original cost when last in, first out is adopted. Increments add new layers when ending inventory increases. Decrements consume the most recent layers first, and in rising price environments, they can create a last in, first out liquidation effect by releasing older, lower cost layers into cost of goods sold. Advanced last in first out topics include pools, dollar value last in first out, the last in first out reserve, and the tax conformity rule. The logic is simple, but the records are technical. Last in first out without a clean layer schedule is like a warehouse with no aisle labels. Valuation tests protect recoverability. For most non last in first out and non retail inventory, use lower of cost and net realizable value or NRV. NRV equals estimated selling price less estimated costs of completion, disposal, and transportation. If cost exceeds NRV, write inventory down. For last in, first out, and retail inventory methods, use lower of cost or market or LCM. Under LCM, market starts with replacement cost, but it cannot exceed the NRV ceiling or fall below the NRV less normal profit floor. The key is to match the valuation model to the cost method in use. Estimation methods support practical reporting, but they have limits. The retail inventory method converts ending inventory at retail value back to estimated cost using a cost to retail ratio. It is useful for retailers, but it needs consistent markup tracking and separate valuation analysis. The gross profit method uses a historical gross profit rate to estimate cost of goods sold and ending inventory. It can be useful for interim periods, insurance claims, or when a count is temporarily unavailable, but it is not the basis for year end US GAAP reporting. Relative sales value allocation assigns a lump sum purchase cost across items based on each item's share of total expected sales value. Estimates are useful, but year end evidence still matters. Journal entries follow the accounting conclusion, not the other way around. A purchase of inventory debits inventory and credits cash or accounts payable. A sale at cost debits cost of goods sold and credits inventory. A write down debits loss on inventory write down or cost of goods sold and credits inventory or an allowance to reduce inventory to NRV. An increase in last in first out reserve debits cost of goods sold and credits last in first out reserve. Production costs are capitalized by debiting work in process and crediting raw materials, wages payable, or overhead applied. Do not memorize the entry before identifying ownership, cost basis, method, and valuation conclusion. Inventory policy must be understandable to financial statement users. Disclosures should explain the cost flow method or methods used, such as first in, first out, last in, first out, average, or specific identification. They should also describe major inventory classifications such as raw materials, work in process, finished goods, or merchandise. Last in, first out entities need reserve disclosures and material liquidation effects when relevant. Companies should also disclose material write downs, unusual losses, significant estimates, obsolescence reserve policies, and method changes under ASC 250. Related topics include ASC 705 for cost of revenue, ASC 606 for revenue and cutoff alignment, ASC 835 for interest capitalization, ASC 275 for significant estimates, ASC 740 for income taxes, and ASC 250 for accounting changes. The inventory close process needs strong controls. Teams should lock shipping cutoff procedures at period end and confirm FOB terms for all in transit items. Receiving and shipping logs should be reconciled to inventory records. Consignment goods should be physically identified and separated from owned inventory. Capitalization policies and overhead allocation bases should be approved by management. Inventory subledgers should reconcile to the general ledger. Slow moving, obsolete, and excess inventory should be reviewed. Last in, first out layers, pool definitions, and reserve balances should be validated. Valuation evidence should support NRV or LCM conclusions. Good controls make inventory boring, and in month end close, boring is beautiful. Now let us lock the common mistakes. Do not count goods not owned, such as consignee held goods or FOB destination goods, before title transfers. Do not miss FOB shipping point goods that left the seller before period end but have not arrived at the buyer. Do not capitalize selling costs such as freight out, sales commissions, or marketing. Do not apply the wrong valuation test, such as using NRV for last in, first out inventory or forgetting the LCM ceiling and floor. Do not ignore last in, first out liquidation effects. Do not treat retail method or gross profit method estimates as permanent annual evidence. Most mistakes are sequence mistakes, so use the master map and work in order. The key US GAAP and IFRS differences are very exam friendly. First, last in, first out is permitted under US GAAP with conformity and reserve disclosure requirements, but last in, first out is prohibited under IFRS. Second, US GAAP uses NRV for most inventory and LCM for last in, first out and retail method inventory, while IFRS generally uses lower of cost and NRV without the LCM ceiling floor framework. Third, US GAAP generally does not permit reversal of inventory write downs, while IFRS requires reversal when NRV increases, capped at the original write down amount. Fourth, US GAAP allows more flexibility in cost formulas, while IFRS requires the same cost formula for inventories of similar nature and use. The biggest memory anchor is simple. IFRS prohibits last in, first out. The SAP comparison is intentionally limited for ASC 330. Statutory accounting principles are designed around insurer solvency and policyholder protection, not commercial inventory flows. Only GAAP guidance expressly adopted by the NAIC or the relevant statutory authority becomes part of SAP. Commercial inventory is not usually a core insurance balance sheet item, so forcing a broad SAP comparison here would create confusion rather than clarity. The useful discipline is this: always check whether a particular GAAP standard has been adopted for statutory reporting before assuming the treatment is the same. That habit is valuable even when the direct topic comparison is narrow. Use the ASC 330 answer letter for exams, interviews, and close reviews. Step 1. Identify inventory and scope. Step 2. Decide control and cutoff using FOB terms, consignment rules, and title transfer analysis. Step 3. Build inventory cost by capitalizing normal acquisition and production costs while excluding selling and abnormal items. Step 4. Select the cost flow method and apply it consistently. Step 5. Apply last in, first out layers if needed, including pools, indexes, and reserve disclosures. Step 6. Test valuation using NRV or LCM depending on the method. Step 7. Record the entry and disclosure. When inventory questions feel messy, climb the ladder in order. And with that, ASC 330 is complete. You now have the full inventory accounting map. Control first, cost follows condition and location, flow assigns timing, last in, first out needs discipline, valuation protects recoverability, and controls protect credibility. Inventory may begin as goods on a shelf, but financial reporting turns it into a chain of recognition, measurement, presentation, disclosure, and evidence. Thank you for studying this series with me. If it helped you understand inventory more clearly, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP. We will continue the Commerce Regiment US GAAP course with the next ASC topic.